Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. We're coming to you live from the MarketSite studio in Times Square, New York City. And joining me, we have Max Cabasso, managing director on Nasdaq's market intelligence desk. And really what the question is, Max, can we trust these bounces that we have been seeing, or do you expect longer term volatility?
I think in the long term, we're going to see more volatility. Right now, we're in a bit of a, I call it a no man's land, a bit of a dead zone. There's not much in terms of economic data coming out. The next CPI print is not until, I think it's July 13th. Next Fed meeting is until the end of July. So, and corporate earnings don't pick up again until mid-July. So we're in this kind of no man's land here where there's not much to go off of, and it's just more of narratives. Are we going to see a drop in prices? Is oil going to come off? But we're seeing that peak demand over the summer. So I think, again, short term, we're seeing a bit more of a volumes coming off and quiet, but I still think in the long term there's going to be more volatility ahead.
And I feel like that kind of always happens when you have that like 4 to 5 week lull of earnings and you're just neurotically focused on what's happening in the macro environment. And of course, there's a number of macro issues that the market is certainly worried about. But I also think when we see these moves with 1.5%, 2%, 3% moves to the upside, and then there's no follow through, there's just no long-term trend to base this off of.
For sure. There's not a lot of conviction anywhere. We're seeing these short-term bounces. Hearing some anecdotes that it's a lot more of the shorts coming off and it gets a little squeezy. But if you look at the Qs, the July option expiry, the 280 strike, which is essentially where we're at right now, it's by far the biggest contract that's open. So it's really kind of just at the money that's being traded. I talked to two different traders today, one on the futures desk, one on the cash desk. They echoed similar sentiments that it's not much conviction, a lot of cash sitting on the sideline, waiting to be put to work, but no one wants to get ahead of anything. No one trusts the bounces. And even again, in the short term, without much macro data coming through to the short side as well, what is the catalyst going to be to move the stock market in either direction? So it's a lot of kind of sitting and waiting until we get these new earnings prints to come out to see what are corporates doing, what's the Fed going to do, what's inflation going to do, and again, that's not for another month.
Right, and then you also have a low summer environment, right? And liquidity is a little bit tighter than it was over the past couple of years. So if we take a look at your first chart here, what are some of the levels that you're watching the Nasdaq 100?
So we're really it's almost like a 1,500 point range, which is obviously pretty wide, but to the downside, it's that 11,000-ish mark. To the upside, it's that 1,250 or 12,500. Below 11,000, it's really 9,700, which is the February 2020 highs before we initially sold off with COVID. But it's really that range. We'd kind of tested it to the downside, and that's where we bounced. And again, the 1,250 is kind of where we failed, recently. So it's really that range where I think for the next few weeks, again, until we get those catalysts, we could see just kind of bounce it back and forth between there.
I mean, it is just so crazy in such short of a time how we've essentially retraced the gains that we saw with that COVID momentum. I mean, granted, the returns that we saw were unprecedented. It isn't like your typical, 8 to 10% average stock market return, but to see the velocity of the moves both ways, I mean, whether it's up or downside, that's not sustainable.
Yeah, it's been a pretty, everything we've heard is more, it's just velocity. It's not so much how big, it's just how quickly everything's happened. If you look at bond move, how quickly bonds have fallen off, just the velocity of the moves in the 10-year, the yields, everything has just been super quick. But the strange part is you haven't seen that real uptick in volatility. Usually, if you look, I know it's another chart we're going to look at shortly.
Well, we would pull up that chart right now, the one with the VIX.
Pull it up, the VIX. Right now, we're at 29. Even last week, we had that real big sell-off. We got to about 35. We really haven't seen anything above 40. If you look back at the COVID highs, the VIX highs in COVID were 70s, 80s, where you saw real fear in the market, and we haven't really had that. So we've seen this kind of washout in stocks recently, but the volatility hasn't been kind of what you would expect it to be, which would kind of give you that signal of, okay, we got really flushed out, the fear is out there, now we got all of that behind us. Everybody keeps looking forward to when is that going to come, waiting for essentially that next shoe to drop. And volatility and the VIX index has not shown that that's happened yet.
Which is so bizarre because we saw this in 2008, 2009, in fact, in the dot-com crisis, if you want to go back farther. We saw it in 2008, 2009. We saw it with the COVID lows in March and April. We had those extreme moves to 70, 80 plus. And the fact that it's been hovering around 30, which is historically high for the VIX, for a number of months at this point, is a little bit concerning. It's not providing any sort of direction, and we're not getting that capitulation that we're looking
Right,
for.
we're just sitting there now at that 30. You know, for years the trade that everyone was doing was selling volatility. Just sell the
Right.
VIX, sell vol, and take in those coupons, you know, take in the money. And now, you know, that's sub 20 forever, just stayed there.
Right.
Now we're kind of just sitting at this, you know, 30 level, which again, he said is elevated. We haven't seen that real spike, and it's kind of, we're worried, but no one's afraid, if that makes sense.
Right.
We haven't seen that real wash, haven't seen everybody capitulate, get all the selling out, where we can then kind of set up a base to then potentially move higher in a confirmed move where we say, okay, there's belief in the market that we're actually going to move higher, and not just these, you know, 1 or 2 day moves higher, which are followed by, you know, the selling the next day after that, where it just kind of erases all the gains.
But do we have to get capitulation, or is that a self-fulfilling prophecy? What if we're like this for a couple more quarters?
I think I don't know if we're going to get that wash. I don't
Right.
know if we need it, because we're in unprecedented times with the Fed raising rates potentially into a recession. We're doing this, obviously they're raising rates with, you know, with inflation as high as it is, but there's only so many levers that they can control. So this could be a prolonged, you know, 6, 9, 12-month period where there's questions. What is the Fed going to do? Are they going 75 or 50? Where the status quo is this just kind of elevated level of uncertainty, but it's not super fearful. Again, there's a cash cushion that, you know, consumers have, that corporates have because of everything that happened post-COVID. So they have a bit more of a cushion. So no one's really overly worried at this point, but it's just kind of that heightened sense of, you know, what's coming next, what's coming next. So I could see it obviously staying at this kind of 30 level and just, you know, elevated volatility, but not that real big, you know, spike up in the VIX.
All right. Appreciate the insight as always, Max. Thanks for
Jill.
joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.